Well, right now we're in the second week of a pullback, period. So in fact, it's not even a full 2 weeks because, anyway, the number of days is a handful. And I suspect this will be brief. It won't be multi-month. I don't think we're going to correct like everybody seems to think. We're going down to 2,800. I think what people are doing, or price chart is primarily, is when they project, oh, it's all over for now. We got to go back down to here. Every time they do that, what they're doing is they're finding the prior shelf of highs that was broken through, and then you get a surge, and they seem to insist that you must go back to that prior high to test the price high. And gold hasn't done that. Instead, it's pulled back, but never gone back to the prior high. And right now, the assumption is, well, we're going to have to drop $500 from the high to get down to 28.
We're only about 2 weeks into a pullback, and it likely won't last long. Despite widespread expectations of a significant correction down to $2,800, the speaker doubts that. People often assume prices must return to previous highs after a breakout, but gold hasn't done that. It's pulled back modestly without revisiting old highs. The belief that a $500 drop is necessary seems exaggerated. A seasoned financial analyst, Michael Oliver, argues that despite a recent short-term pullback in markets, this isn't the start of a long correction. Many expect gold to drop back significantly, but historical patterns suggest otherwise. They highlight the unusually low silver-to-gold ratio, just 1%, as a strong indicator that silver may soon outperform, as it has in past cycles. Broader monetary issues, like massive global money supply increases and U.S. debt concerns, also push gold higher. Meanwhile, the bond market behaves abnormally, failing to rise as a haven during stock market declines, signaling deeper problems. The stock market's recent bounce, sparked by temporary trade war optimism, masks underlying structural weaknesses from an overinflated bubble that is now unraveling. Let's explore the video in more detail. If you find this content helpful, give it a thumbs up and subscribe to stay updated with our latest videos.
If you go back 50 years and look at the silver divided into the price of gold expressed as a percent, 1% is super low. So in other words, either it's going to hell and going to zero, okay, which isn't going to happen, or you're looking at a bargain. Because anytime silver gets down to 1% of the price of gold, look out the next 6 months or so and you'll see drama. Okay. In fact, this happened. It got down to 0.8% the price of gold in that COVID sell-off. And in the next 6 months, silver went off the page percent-wise. While gold had a nice, 40-50% move, silver doubled in that 6 months. There is, when you plot the spread relationship, not just the spread itself as a chart, we also run momentum of the spread. And what we're saying is that spread now has gotten bound below the 1% level, and it's just marginally below it right now as we speak. You get back above about 1.1%. That sounds trivial, but when you divide this over into gold and you see it get up out of this hole and it's saying, I'm coming out of here again. And there's another level up at 1.3% of the price of gold that if you go through that, the lid will come off. You'll gush to 2% in a heartbeat. 1% to 2, who cares? Well, that's a doubling of the value of silver versus gold. It's like buying something at 1 and it goes to 2, okay? So we're keenly watching the silver-gold relationship because when that breaks out, it's never a situation that you have that gold is going down more than silver and silver's holding and therefore silver's appreciating versus gold by not going down as much. It's always a situation where silver's going up much more than gold. So it's always bullish when silver-gold situation shifts into positive. It's an interesting fact. China's buying, China's buying, China's buying. And they try to report on it every week. How much did they buy? And in we understand that just recently there was 1 million ounces sold, which isn't that much, in the bigger scheme of things, from Chinese, probably citizens, not the central bank necessarily. And everybody thinks that's all you get to watch. No, it's not. Gold moves on far broader trends in monetary degradation globally, not just U.S. money degradation, but global. I saw a report the other day that global money supply has gone up 200% over the last 15 years. 200%, meaning the quantity of money has gone up. Therefore, the purchasing power, the real buying power of those money units has declined. And for the dollar, going back to the 1950s, every single decade, look at M2 and see it went from here to here, do the percent, and you'll see that it almost doubles every decade. And by the way, the other thing I would be looking at in terms of what's the Fed going to do is not just the data points, the economic data points, because they're going to go sour big with the stock market. They follow the market. They don't lead the market down. Is the T-bond market. Treasury bonds are normally another alternative place to put your money if the stock market is in trouble. And yet since the stock market dropped 20% from January to April and now has bounced, but the bonds haven't risen. They've tried repeatedly to rise in price, drop in yield. I'm talking 30-year bond futures, for example, not the short end of the market that the Fed controls, but the long end of the U.S. government debt market. Now, we even thought technically there was justification for T-bonds to participate with gold as an alternative to the fractured stock market. And we saw a nice surge. Back early this month, T-bonds shot up to 122 on the T-bond futures from lows down in the mid, 1-teens, 115, 114, etc. So there was a big surge in price and a drop in yields, but it crashed. T-bonds in 2.5 days went from 122 in price to 111. For T-bonds, that's a crash. That kind of percent drop, especially in 2.5 trading days. And since then, they bounced back up about halfway to that 122 high. And I think the best we've seen is about 117 or so. Right now, we're trading the 115s. I think even today, we traded under 115. So the T-bonds are lame. They're not functioning as they normally do as an alternative place for money managers to shift some money to avoid risk in the stock market. What's going on there? That is of great concern to the central bank and to the government itself. So don't just look at the data points. If that T-bond market doesn't start to behave, in a healthy manner, and especially if the stock market starts to go down again and you don't see bonds go up, what's going on there? Well, we know what's going on. The big fundamental is we have a government debt crisis. The question is, when is it going to occur? Right now, T-bonds in the high 114s, you don't want to ever see the nearby futures. It would be the June T-bonds right now, down to 111.5 again. We argue you close a month down there, they're going to flush them. That's what will panic the Fed more than will the stock market. So watch the T-bonds and the dollar as well, which is a crippled bear market as far as we're concerned. If you're not already out, which we would be, in January we said get out for the S&P, and in early March the NASDAQ 100 said get out, and they both puked. And we predicted a bounce point. And they went right down to our bounce point, just above 4,800 on the S&P and at 16,500 on the NASDAQ 100, two levels that we had predicted prior to that they would bounce from. And they have bounced. It's now been a month of bounce. Most of that bounce, by the way, occurred about 2 days after the low. If you recall, I think it was April 9th when Trump said, okay, we'll have a 90-day pause. The market exploded then. And we are now above that high, that rally high. But most of the action since then has been below that high until just recently we nudged out above it. And then where's it going to go up to? And today, for the first time, the S&P has gotten up to our number area that we suggest is likely zone of resistance. Watch the next few days and see what happens. I know they think the world is now pivoting on one single thing, and that's the China-U.S. trade stuff. And we argue that no, there's a far bigger problem here. That's merely a provoking item. Reveal internal weakness. The weakness being the effects of a bubble in stock market history, U.S. stock market history. And it's broken, and I think that ultimately you'll find excuses all the way down as to why it's going down, but the real reason is deserved to turn down. It was overdone, it was excessive, it created built-in errors, and those errors are being exposed.
While short-term market fluctuations may grab headlines, deeper financial trends point to long-term instability, fueled by excessive debt, monetary expansion, and a distorted bond market. Gold and silver, especially with silver's historically low valuation relative to gold, may offer refuge as traditional markets falter. Investors should be cautious of surface-level optimism and stay focused on underlying economic realities. Could silver's current undervaluation signal a significant shift in precious metal markets ahead? What does the bond market's failure to act as a haven imply about investor confidence in government debt? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos.